Okay, hello everyone. Once again, for those who just joined, hello. Welcome to today's webinar brought to you by Vantage. Today's the 12th of December. We're gonna be touching a little bit about China and yeah, the China puzzle. Is it growth or is it global risk? So we're gonna understand a little bit of what's going on in China. This is a really interesting topic. This was a topic that I was very excited to do research on and to prepare for you guys because I too want to know what's happening in China. They always say China is a sleeping giant, but I mean, I don't know. I know I am Chinese, but I'm not from China Chinese, so I don't actually know what's happening in China. Yes, people who are not born in China wouldn't know what's happening in China, right? So I was not born there. I never grew up there, but I am Chinese living outside of China. And yeah, so I am curious to know what the sleeping giant is doing these days. Yeah, so before we start, as usual, you guys know I need to go through the disclaimer with you guys. I will have to stay here for a minute or two in a bit, but basically the disclaimer is a reminder to you guys that this webinar should not be construed as any form of trading advice, any form of financial advice, any form of signal to buy or sell. It is purely educational. Okay. Please take this webinar purely as educational. I'm just here to share information with you guys. What you want to do with that information is entirely up to you guys, but please do not take it as a signal from me for you to buy or sell. Okay? You take that information and then you see how that can improve your trading. Okay, please do your own due diligence before trading. All right. Hi, Nina. Hi, Richard. Hi. Okay, for those who are here every week, you guys know how this works. If you are tuning in from Zoom, I will be able to see your messages because there's only like close to 20 of you on Zoom, whereas on the Vantage app, there's 1,200 of you. Okay, 1,200. So sometimes if the chat's moving really crazy on the Vantage app, I won't be able to catch your message. So those who are on Zoom, I will definitely be able to give you a bit more attention compared to those who are on Vantage app. Okay? Yes, big audience. It's very normal for Vantage. Okay, so just staying here for a minute for especially for those who just joined, so you guys can read through the disclaimer. But again, the disclaimer is just a reminder that today's webinar should be construed as educational and not any form of advice. Advice to buy or sell, okay? Okay, cool. I think that's about a minute now. You guys got the whole point of the disclaimer. Okay, I'm gonna continue. Okay, so I'm going to introduce myself, your host for today. My name is Cassandra. You guys can call me Cass. I am an investment analyst at Everest Fortune Group. We are a research firm that is based in Singapore. So what do we do at this research firm? We do a lot of back testing, a lot of forecasting, a lot of analyzing and research of the markets to see where it's going, to understand certain pairs, to understand certain commodities, cryptocurrency, whatever it is, our job is to study the markets thoroughly. Okay, so we have been recognized as the finalist for the best Forex and best equity research for multiple years running. Okay, so we are very versed with the markets. On top of that, I am a prop trader. That means that I do trade for multiple companies. How did I get funded? I had to pass a test. The test required me to do 10% profit within a month. I've consistently done 10% profit for many months. Not back to back, but yeah, 10% profit for me isn't that hard. How do I do it? I combine technical analysis with fundamental analysis. I'm mostly a technical analysis trader. I trade mostly on technicals, but recently, especially since I started doing these webinars for you guys, I combine a lot of my fundamentals now, and I find that my trades have been winning a lot more than losing. So yeah, It's way easier for me to get to that 10% nowadays that I combine fundamental and technical analysis together. This is important because I know some of you will see the topic and you'll be like, okay, another economic topic, another geopolitical topic, okay, whatever it is. But it is important because it will help you find better trades because it will help you make better informed decisions. Okay, so our agenda for today is to understand China's economic transition after the property crisis, how China's slowdown affects the US dollar, sorry, not the US dollar, Australian dollar, New Zealand dollars, and commodities. Beijing's, okay, in Chinese, we pronounce it at Beijing. Beijing's stimulus policies, do they still work? And trading opportunities in Asia during policy shifts. Okay, so we're going to understand a little bit about all four of these topics today. Okay, I see the Vantage app chat moving like crazy again, as usual. So, if any point of time you guys have a question, just shoot me in the chat box. It doesn't even have to be regarding today's topic. Obviously, I will prioritize questions that are based on today's topics. But if you ask me something, anything regarding trading, I will still answer you. Okay, so just ask in the chat box. I will do my best to help you guys get the answers. Okay. If I don't have the answers, I'll tell you immediately that I don't know because I don't want to pretend like I know the answers. There is no one trader or investor or whoever out there who has all the answers to everything. Okay. That's impossible. The markets are too vast, okay, to completely understand everything. Therefore, I'll answer you to the best of my ability if I know the answer. Okay, so let's start with China's economic transition after the property crisis. Okay, so let's start by looking at the property boom to pain, how China's old growth model broke. So let's zoom in or zoom out actually and understand what actually broke in China's economy after the property crisis. So for more than a decade, China's growth model was very heavily driven by property and infrastructure. If you think about it like a body, okay, the property sector was almost like the heart, pumping credit and activity into everything else. Steel, cement, copper, home appliances, local government finances, even household wealth. Okay, local governments relied on selling land. Developers borrowed aggressively to build, and household bought homes not just to live in, but as investment and retirement savings. Okay, so for a long time, right, this model worked because China was urbanizing at high speed. Oh, by the way, guys, I will also hold a Q&A session at the end of the webinar. So I will probably finish the entire webinar in like 45 minutes. Okay, I'll finish all my slides in 45 minutes and then we'll have like a short 15 minutes Q&A session or maybe a 10 minutes Q&A session. Then you guys can also ask me questions there if you guys want to wait until the end. If there's something that is on your mind right now, you can also ask me in the chat box and I will answer you. If it's not like on the top of my mind or urgent, I'll just answer you later when we get to the Q&A session so that we can quickly finish the slides. Okay, so where were we? I was saying, okay, so for a long time, this model worked in China because it was urbanizing at a very high speed. Millions of people were moving from rural areas into cities, and there was a genuine demand for housing and infrastructure. But over time, you got more and more leverage, more speculations, and more building that was not necessarily driven by real end user demand. That's where the stories of ghost cities came from. Okay, I put a picture of an example of a ghost city. Okay, entire areas built on the assumption that growth would continue forever. What we saw with companies like Evergrande wasn't just one bad developer collapsing. It was more like a symptom of a deeper structural problem. the whole ecosystem around property, developers, local governments, banks, shadow banking had become dependent on ever-rising land prices and ever-increasing construction. Okay, so once Beijing started tightening rules, especially on leverage and risk in the property sector, the music stopped. Okay, suddenly developers couldn't roll even over their debt as easily. Pre-sales of these properties slowed down massively, and the old model of borrow more, build more, sell more kind of broke. Okay, so when we talk about China's economic transition after the property crisis, what we really mean is this: the country is being forced to move away from growth strategy where property and infrastructure did all the heavy lifting. That's not a minor adjustment. That's like telling an athlete who has trained one way for 20 years that they now need to completely use a different muscle set. Okay? It's like you're doing things one way for many, many years, and overnight, I'm telling you, you need to change your ways right now. Okay, so it takes time, it's messy, and there are a lot of unintended consequences, especially for jobs, local government, finances, and of course, global markets that were plunged into that property boom through commodities and exports. Okay, so what comes after the bubble? Rebalancing towards consumption and high tech. Okay, let me see. Now that the old model is clearly under stress, right? We're talking about like infrastructure and property and whatnot, okay? The natural question is, what is Beijing trying to pivot towards, right? So you have a problem, you now need to find a solution, okay? You know the old model does not work. You need to like pivot. You need to like change your ways. If not, your economy is gonna die, right? Your economy is gonna suffer. So the broad answer is at least, well, at least on paper, it is a transition towards more sustainability, consumption-driven and innovation-driven growth. Policymakers have been talking for years about wanting Chinese households to spend more, wanting the economy to rely less on debt-fueled construction and more on services, technology, green energy, and domestic brands. So if you think of it in a simple terms, the old China story was build more roads, build more apartments, build more factories, export to the world. The new China story that Beijing is trying to write is upgrade the value chain, dominate key technologies, grow the middle class, and rely more on internal demand. Okay, that being said, right, guys, I do have to say, maybe I am a little bit biased. I am very, very proud of China's growth. Okay. China is the one country that I have not been to China in a long, long time. I used to go there when I was flying with Singapore Airlines. Yes, I used to be an air hostess, air stewardess. Okay, so when I was flying Singapore Airlines, I used to go to China, but now I haven't in recent years. But I've heard and I watched videos on social media of them booming so much, and the middle class is just everyone is everyone just has wealth. Okay, everyone is doing okay. Everyone is comfortable, which is good because they're essentially eliminating poverty. So I'm very proud of them for as a country to be like taking care of the entire nation as a whole. Okay, so they have a very clear plan and it's working. Okay, so that's why you see big pushes in areas like electric vehicles, batteries, solar, semiconductors, and AI. Okay, all these areas is growing, the tech area is growing like crazy because they noticed that the old model doesn't work anymore. So these are the sectors they hope will become the new engines of growth, replacing some of the lost momentum from property. But this transition is not easy. It's certainly not smooth as okay, it's certainly not smooth. First, consumption doesn't magically go up just because the government wants it to. Chinese households have been through COVID lockdowns, job uncertainties, and falling property prices. Okay. And remember, property is where a lot of their wealth is stored. Sorry, I see a question. Would you transition mean state-owned Chinese banks? Would this transition mean what would this transition mean to Chinese state-owned banks? Okay, very good question. I will come back to you on that in a bit. Thanks for asking. Actually, now I need to ponder on that. Let me think of a clear answer and then I'll come back to you because I don't want to give you a rushed answer. Okay. Sorry, where was I? Okay. So when your main asset is not appreciating anymore, which is property, or even declining in value, you don't feel like going out and spending aggressively. So Beijing is trying to encourage spending, but households are still cautious. So second, shifting to a more tech and service driven model takes time. You can't just close a construction site and open a semiconductor factory next week. Or rather, in China's case, the speed that they're going, they can, but it wouldn't be next week. Okay, so the skills are different, the capital needed is different, and the global environment is more competitive. Okay, especially with geopolitical tension in areas like chips and advanced techs. So what we're seeing is a kind of tug of war. The old regime engine is sputtering, but the new engines aren't yet strong enough to fully replace it. As traders and analysts, the key thing to understand is that this isn't a simple like V-shaped recovery story. Okay, it's more like a long messy structural change. There will be moments where data looks better because of short-term stimulus or temporary rebounds, and the periods where growth slows again because the structural drag from property is still there. This is why market often struggle to price China right now. The old playbook doesn't fully work anymore, and the new playbook is still being written. Okay, so let's move on to the last part. I've got two questions here. I'll answer you guys in a little bit. Let me just finish this last section and then I'll get to your questions. So why do we, as traders, care so much about China's economics transition after the property crisis? It's because China is not just another economy. It's one of the biggest buyers of commodities. Okay, a key trading partner for Asia and the major anchor for global manufacturing and supply chains. When its growth and model shifts, it spans waves through everything from iron ore, copper to AUD, Australian dollars, New Zealand dollars, Asian equities, and emerging markets forex. So I've placed a chart here of what China's demands for commodity has been. Okay, so we've got cement, aluminium, nickel, coal, copper, steel, gold, oil, rice, pork, corn, and cotton. And yeah, so if China's growth slows down, you better bet that the rest of the world is going to be affected because they are a very, very key player. Okay. Okay, so during the boom years, China's relentless demand for raw materials supported strong prices in iron ore, coal, base metal, and even energy. That in turn fed into the strength of commodity-linked currencies like the Australian dollars and the New Zealand dollars, and supported growth in economies that export heavily to China. When the property sector downshifts, that whole ecosystem feels it. You get weaker demand for steel, less appetite for construction inputs, and more cautious investment plans for Chinese corporates. That tends to weigh on commodity price and on the currency and equity markets that are tied to them. But beyond the direct trade channels, okay, there's also a psychological and risk sentiment angle. China has often been seen as a major pillar for global growth. When investors worry that China is slowing in a structural way, not just like one bad quarter, but a long-term deceleration, they start to question broader global growth assumptions that can trigger risk off episodes where investors reduce exposure to emerging market, cut positions in Asia, and flock back towards safe haven assets. So at the same time, we need to recognize that China isn't collapsing, it's evolving, it's changing its strategy. Okay. Growth is slower, but the composition of the growth is changing. For us as traders, that's both a risk and an opportunity. It means that we can't just look at headlines GDP and say, okay, strong China equals strong commodities, like the old days. We need to look deeper. What sectors are Beijing supporting? Where is credit flowing and how are households behaving? Is policy leaning towards stabilizing growth or tolerating slower but higher quality expansion? So when you hear the phrase China's transition after the property crisis, think of it as a shift from one gear to another in a very big, very complex machine. The machine is still running, but it sounds different. It affects different assets in different ways. Our job as traders is to understand this new sound and positions ourselves accordingly instead of trading as if we're still in 2010 property super cycle. Okay. Okay, let's move on. But in the meantime, let me answer some of your question. Okay, so I've got someone asking, what does this transition mean to state-owned Chinese banks? Okay, I think that's a really good question. What does this mean for state-owned Chinese banks? So the big picture is state-owned banks are moving from being growth amplifiers to becoming stabilizers. Okay, to put it away. Okay, so during the old model, banks were aggressively lending to property developers, right? So local governments and infrastructure projects, okay, these are the people who are borrowing. That was their role: push credit, fuel construction, and this way it supports the GDP. Now in the transition phase, their roles become more cautious and more strategic. So they lend more selectively. Okay, they support policy targeted sectors like EVs, renewable energy, tech. Okay, they maintain credit stability to prevent shocks and they maintain non-performing loan risk from property. So instead of being the engines of expansion, uh, these state-owned banks are now becoming buffers against instability. Okay, so they're not that easy to borrow from anymore. Okay, I've got another question. How do you differentiate noise from a real shift in China policy? So the difference is duration. Okay, noise, is a few days. Okay, it can be like a quick market panic. The real policy shifts show in credit flows, PMI trends, commodity demands, and a tone from Beijing. Okay, so if all of this aligns, that's real. Anything else is just noise. Okay, you need to see it on a very long term. Okay, so let's continue with how China's slowdown affects the Australian dollars, the New Zealand dollars, and the commodities. I mean, we all see it, right? Everybody can see it. Australian dollars and the New Zealand dollars are dropping in value. Okay. Why China's demand drives these currencies and commodity pricing. So when we talk about China slowing, we're not talking about something that sits in isolation on a Bloomberg chart. Okay, we're talking about real shifts in trade flows, real changes in commodity consumption, and therefore real impacts on currency like Australian dollars and the New Zealand dollars that are directly tied to China through trade and investment channels. Australia and New Zealand don't just have a casual relationship with China, they're deeply, deeply linked. By the way, I've studied in Australia and I lived in New Zealand for a bit. I can tell you they are quite racist, right, to Asians, but I sometimes I feel like telling them like without the Asians, your country's economy will go bust, right? They're racist, but they don't know that they need the Asians. Okay, so China is actually Australia's largest export market, by the way. Okay, especially for iron ore and coal. New Zealand sends a huge portion of dairy and agriculture exports to China. So when Chinese demand softens or when investors believe China's growth trajectory is weakening, those commodities flows get repriced and the forex reacts immediately. Take iron ore, for example. China consumes more iron ore than the rest of the world combined. Okay, that's the steel story. The steel for construction, manufacturing, autos, infrastructure. When China's property sector slows, the demand for steel contracts and iron ore prices fall. And guess what? The Australian dollars doesn't wait for Chinese GDP data. Okay, it trades in anticipation of reduced orders, lower port flows, and weaker sentiments in the steel ecosystem. So with the New Zealand dollars, the linkage is more agricultural and than industrial, but it works the same. When Chinese households and corporate feels cautious, they reduce consumption of imported goods, including dairy. And when the domestic property market feels weak, wealth effects kick in. Chinese consumers spend less, and that impacts New Zealand dollars exporter revenue. So when we say China slowdown affects Australian dollars and New Zealand dollar, it's not a soft theoretical statement. It is a fact. Okay? It is a fact. China contributes a lot to Australia and New Zealand's economy. Okay, so it's a chain reaction that goes from sentiment, demand expectations, commodity pricing, currency flow, and that's why traders keep China PMI data, credit growth data, import numbers, and policy announcements on their radar because those things translate directly into forex behavior without needing to wait months for confirmation. Okay, so when China's economy cools, commodities don't suffer evenly. Some take the hit harder than others. Industrial metals like iron ore and copper typically reacts the fastest because their price reflects forward demand expectation from construction, infrastructure, and manufacturing. So if China's property sector is slowing or if stimulus is underwhelming, iron ore can drop very quickly and it tends to spill over into the AUD weakness. Copper is another bellwether. Okay, traders often call it Dr. Copper, okay, because it has a PhD in economics. It reflects manufacturing sentiment. If Chinese factories pull back, copper prices soften, and again, the market interprets this as weaker global demand. So even if Chinese GDP looks okay on paper, commodities tell the truth, and forex traders watch that truth closely. For agriculture and dairy, the mechanism is a bit slower. Prices don't collapse overnight like metals do. They respond more to household and business confidence. When Chinese consumers feel cautious, they reduce discretionary spending. So New Zealand dairy exports don't disappear, but pricing softens. Inventories build and New Zealand dollars gets dragged lower through the trade channel. Okay, so for traders, the key takeaway is this: commodities are leading indicators of China's growth expectations. They move before official data prints, and Australian, US, AUD, NZD reacts before commodities even finish pricing the full slowdown. That gives us windows of opportunities, trading into weakness, fading overreactions, and positioning ahead of turning points. So whenever you look at China's slowdown headlines, think commodities first. They are the transmission medium. They translate macro stress into tradable forex flows. Okay, so every China slowdown plays out in a very consistent hierarchy of forex moves. The Australian dollar usually reacts first because China demands hits iron ore and metals almost immediately. And these commodities are priced continuously in global future markets. When iron ore slumps, the Australian dollar slumps. Okay, that correlation becomes especially sharp during bearish China cycles or weak PMI periods. The New Zealand dollar reacts less violently at first because dairy and agriculture aren't repriced as quickly. But over time, the directional story tends to match. If China sentiment stays soft, New Zealand dollars eventually follow Australian dollars lower. Okay, sometimes New Zealand dollars even becomes more sensitive when Chinese consumer related sentiment worsens. What many newer traders miss is the spillover into broader Asia forex. You can see pressure on Singapore dollars, the Malaysian ringgit, the Korean won, and the Taiwanese dollars, not always through direct trade channels, but through the risk sentiment channel. When global investors worry about China structurally slowing their reduced exposure to Asia risk assets broadly. Okay, this is why during major China slowdown narratives, you see emerging markets, Asia forex under pressure. Asian equities softer and funding currencies like the Japanese yen and the US dollar performing relatively better. For us as traders, the point isn't to panic or treat every China slowdown headline as a catastrophe. Okay, the point is to understand the mapping between China commodities, the Australian dollars, the New Zealand dollars, broader Asia sentiment. Okay. Once you internalize that roadmap, the market becomes a lot more predictable. You'll notice the Australian dollars divergence before the commodities drop, and you'll detect the New Zealand dollars lag. And you recognize the emerging market spillover before it becomes mainstream. They were the real trading edge. This is where it really lies, okay? Not in the reaction to headlines, but the anticipating their cost assets effects. Okay, so let's look at how Beijing stimulus policies do they still work today? Let's find out. Okay, so when we understand this, we need to understand the history of the big stimulus. Why the 2009 and the 2015 were different from today. When people compare today's stimulus to past episodes, they often assume that China can simply repeat the big packages of 2009 or the liquidity support in 2015 and everything will rebound. But the context now is totally different. In 2009, the global financial crisis hit the world. And China responded with one of the biggest credit expansions in history. Trillions poured into infrastructure, housing, railways, and municipal projects. You saw steel mills running 24 hours a day, shipping ports backed up with exports, and construction sites stretching for miles. It wasn't subtle, it was a flood of money. Again, in 2015, when market panicked after the stock market turbulence, China stepped in with liquidity injections, credit easing, and targeted support for financial institutions and state-owned enterprises. Those measures helped stabilize sentiment and commodity markets reacted positively. So Australian dollars and the New Zealand dollars benefited because iron ore and dairy flows picked up. But today, okay, the stimulus isn't the same. It's way smaller, more sector specific, and more cautious. Why? Because China is dealing with much higher death ratio than a decade ago. Local government aren't stretched. Okay, they are stretched, and developers are still repairing balance sheets. Households are cautious because their wealth is tied to property, and banks are juggling non-performing loan risks. So Beijing has less room to do all-in stimulus without worsening long-term financial fragility. So when people ask why is stimulus not lifting markets like before, the simple answer is because China doesn't want another wave of reckless lending. They are trying to do a more controlled, structural approach. Green energy, EV industry, tech upgrading, consumption incentives, instead of just throwing money at concrete and apartments. And markets, especially commodity markets and Australian dollars and New Zealand dollars traders, have learned that modern stimulus doesn't produce the same explosive risk on rally we used to see. Okay, so today's stimulus packages in China are aimed at upgrading the economy. Subsidies for electric vehicles, incentives for solar and battery firms, grant for advanced technology developments, and local government measures to encourage consumption. These are forward-looking strategies meant to improve long-term competitiveness and reduce dependence on the global real estate heavy model. This problem is that while these policies are smart strategically, they don't give you the immediate GDP jolt that massive infrastructure spending gave in the 2000s. Building a semiconductor facility doesn't spike steel demand the way building 50 residential towers does. Helping households buy more EVs doesn't suddenly require millions of tons of iron ore. Supporting consumptions with vouchers doesn't create a surge in copper demand. So the commodity ripple effect is much weaker, and that means Australian dollars and New Zealand dollars don't rally dramatically the way they used to during stimulus cycles. Markets trade expectations, and right now, the expectations is that these targeted stimulus efforts may stabilize the slowdown but won't supercharge growth. That's why you see muted reactions in iron ore, cautious pricings in NZX dairy auctions, and investor skepticism when Beijing announces stimulus packages. On the forex side, and for you and I, it means that the Australian dollars and the New Zealand dollars no longer just spike automatically on stimulus headlines. Traders ask, okay, is this structural or is this cyclical? Okay, does it support heavy industry demand or not? And does it improve confidence or is it just patchwork? Okay, these questions are the reason modern China stimulus is more of a slow burn macro theme, not a quick trade catalyst. Okay, so the important conclusion for traders, can we go back to the last slide? Okay, there you go. So this slide is, I took this from Reuters in 2013. This was from 2023 actually. Passengers car sales in China in May stood at 1.76 million units, recording a rise of 6.9% from April. A total of 580,000 NEVs were sold in the month. Okay, so this was mainly because of the incentive the governments were giving, because the government is giving a lot of incentive subsidies for like electric vehicles. Okay, so they are really, really focusing their energy on no longer construction, no longer property, but into tech. Okay, so the important conclusion for traders is this. China's stimulus today is not designed to create runaway growth. It's designed to prevent deterioration. The goal isn't to bump GDP to a 8% again. It is to keep things orderly, avoid systemic financial stress, and buy time while the economy rebalances. So instead of explosive reflation, we get stabilization. Okay. Like one of my answers just now, even the state-owned banks now is focusing on stabilization and no longer into like the heavy lending. That means commodity markets respond more like, okay, things won't collapse rather than, whoa, okay, demand will surge. The currencies like Australian dollars and New Zealand dollars respond with relief rallies rather than major bullish trends. It is also meant it also means that volatility clusters around disappointment. Whether the market expects big stimulus but gets small measures, the Australian dollars and the New Zealand dollars sell off because That mismatch between hopes and reality is where price repricing happens. So from a trading perspective, we need to stop thinking of China's stimulus as a single big event and start thinking of it as a slow evolving narrative. Each policy tweak, consumption moves, credit credit adjustment, and state sector measure contributes to a mosaic. It's that mosaic, not one headline, that shapes sentiment across Asia and commodities. For us as traders, the opportunity lies in correctly interpreting the scale and intent of stimulus. If Beijing signals the stabilization, commodities hold support, and New Zealand dollar and Australian dollar stabilize. If Beijing signals more aggressive interventions because risks worsen, then we trade defensive positioning. The skill here is not guessing what stimulus will do. It's understanding what stimulus is meant to do. And today's China, it's meant to steady the ship, not rocket launch growth. Okay, so let's look into our last part for today's webinar, and then we will go into the Q&A session. So trading opportunities in Asia during policy shifts. Give me a bit, guys. Okay, one, we need to understand when policy shifts create market repricing, where do traders get paid? Okay. One of the biggest mistakes made in thinking that policy shifts are purely negative or purely positive. Okay, that's one of the biggest mistakes most people have. Okay, in reality, policy transitions in China and even across Asia creates periods where markets misprice risks. And that is where opportunity lives, when narratives change faster than data. Prices often swing too far in one direction, overshoot, and then mean revert. Why does this happen? Because policymakers communicate in hints, not PDFs. Investors react emotionally, not mathematically. Headlines grab fear or euphoria, but fundamentals evolve slowly. So you'll see days where Australian dollars get sold off brutally because of a single headline about weak property data in China. Yet iron ore is still trading stable, shipping volumes are still steady, and policy support is being rolled out quietly. That disconnect between the short-term reaction and medium-term reality is where a well-prepared trader can step in. So similarly, there are times when sentiment becomes too optimistic. Markets expect massive stimulus, commodity bulls rush in, the Australian dollar spike, and then Beijing delivers targeted support instead of massive infrastructure blitz. Okay, so that disappointment reaction can open short side opportunities or hedging opportunities in Asian forex. Okay, so the bigger point is this: we don't trade the news, we trade the mispricing that news creates. Policy shifts are messy, they are very, very messy. Okay, sentiment driven, misunderstood, and it's full of asymmetries. And because China is such a heavyweight player, its policy transitions ripple through Australian dollars, New Zealand dollars, the Singapore dollars, the Malaysian ringgit, the Korean won, okay, copper, iron ore, and risk indexes. If you know the mechanism, the reaction flows become predictable. In macro trading, you don't ask, is China's stimulus good or bad? You ask, is the market overreacting or underpricing the effect? That's how you identify opportunities, not by guessing outcomes, but by understanding the behavioral dynamics around policy changes. Okay, so Australian dollars, let's look at some strategies. Okay, Australian dollars and New Zealand dollars as sentiment sensors for China signals. Okay, so the Australian dollars and the New Zealand dollars act almost like early warning sensors to the markets when China policy shifts happen. Australian dollars react first because iron ore and coal respond immediately to sentiment changes. So futures trade 24/7, steel demand expectations shift instantly, and the world watches those markets closely. New Zealand dollars react slower, more measured because agriculture demands take longer to adjust. But directionally, it tends to follow the Australian dollars. Okay, there's always going to be correlation between the Australian dollars and the New Zealand dollars. So when you see China headlines, here's the reality. Okay, the Australian dollars is often the market's opinions before anyone even reads the data. If sentiment becomes negative about China, but commodities haven't actually moved yet, Australian dollars moves anyway. Okay, that means the Australian dollars is tradable both as a proxy for China and as a forward signal for commodities. New Zealand dollars gives you a clear execution profile when sentiment shifts are more measured. For traders who want lower whipsaw exposure, New Zealand dollars can offer the same macro idea with smoother behavior. So if you're reading the China policy narrative and you expect stabilization, you might trade New Zealand dollar long for the slower, less violent shape of the trend. If you expect volatility spikes, Australian dollars gives you the quicker swing opportunities. But the main insight is this, okay? We trade Australian dollars or New Zealand dollars not because we care about Australia or New Zealand's macro. We trade them because they are the global translators of China sentiment. When you internalize that, every piece of China policy becomes actionable through Forex pairs with much clearer direction and clearer sentiment mapping. Okay, so cross-asset opportunities, commodity, Asian Forex, and risk sentiments. China policy shifts don't just move the Australian dollars or the New Zealand dollars, they ripple across an entire cross-asset ecosystem. Commodities often lead Forex because they price expectations faster. Then the Asian Forex reacts through sentiment channels, especially currencies like the Malaysian ringgit, Taiwan dollars, Singapore dollars, okay, Korean won, they aren't as violently exposed as the Australian dollars, but they reflect broader Asia risk appetites. For example, when Beijing signals stabilization, target stimulus liquidity support consumption incentives. Okay, commodities hold support and New Zealand dollar, Australian dollar stabilize, and Asian Forex sees relief pressure, especially against the US dollars. But if China disappoints, weak PMI soft consumption data, insufficient stimulus, we see commodities soften first, Australian dollars sell off instantly, and the emerging market Asia Forex follows later. This creates multiple layers of opportunity. Short-term technical traders on Australian dollars during China sentiment shocks. Medium-term positions trades on New Zealand dollar as stabilization stories emerge. Okay, so cross-hedging opportunities in the ringgit and the Singapore dollars to express Asia risk sentiments and commodity-led trades like iron ore or copper are as leading indicators. So the most profitable trades are when the sentiments and fundamentals align. When sentiments turns positive and data confirms momentum, you see certain Forex trends, okay? When sentiment overreacts but fundamentals are still stable, you get mean reversion setups. And when sentiments and data diverge, you can fade the weaker side or hedge exposure. Ultimately, okay, trading opportunities in Asia during policy shifts arise because the market is always rebalancing expectations and because China's role is so large, okay, so huge and misunderstood that the market frequently misprices risk. If you understand the relationships, okay, like China, the relationships between China commodities, the New Zealand dollars, Australian dollars, the emerging Asia forex markets, and the risk sentiments, you will constantly find setups that others miss. Okay, this is why macro understanding isn't a luxury, it is an edge, especially if when you combine it with technical analysis, it will definitely give you an edge and give you higher probability setups that will just help you be more profitable in the long run. Okay, because I'm sure the only reason anyone joins anything, right? The only reason you guys are here joining my webinars or whatever it is that you join or whatever videos you watch or whatever it is to help you become more profitable in trading. So do spend a bit of time understanding the macro. It will help you in the long run. Okay, let's go into our, oh, that was the last slide. Okay, so I guess we are done with today's topic and how understanding how China affects Australian dollars and the New Zealand dollars. So we do see those two currency dropping in the recent times, also because China is in the phase of stabilization. Okay, so thank you so much for joining my webinar. You guys can follow Vantage on Facebook, Instagram, X, LinkedIn, and Telegram. These are their handles. Go take a look, join them, email them if you guys want to get in touch or whatever. Just you can follow them. We've got about 8 more minutes left where we can do a quick Q&A session. Okay. Okay, so I see questions coming in already. Okay, so there's 1, 2, 3, 4 questions. Okay, let me answer you guys. Sometimes you guys ask me questions and I need a bit of time to think about the answer. Okay, but yeah, let me see. Okay, so does China slowdown automatically mean the US dollar is bearish, or does it depend on the type of slowdown? Okay, that is a very good question. China's slowdown doesn't always mean that the US dollar is bearish. Okay, so the Australian dollars is sensitive to demand expectations, not just slowdown headlines. If the slowdown is cyclical and the stimulus is supporting stability, the Australian dollars can actually consolidate or grind higher. If the slowdown is structural with weaker confidence, then yes, the Australian dollar stays pressured. So context matters more than the headlines. It always matters. Context will always matter. Okay. Got another question. So for New Zealand dollars, is it slower to react because the dairy demand is stickier compared to iron ore? Yes, exactly. So like I said, the dairy consumption doesn't collapse overnight because you still have consumers consuming dairy, right? Even if China has a slowdown. So the repricing of dairy will always take longer than the iron ore, the commodities. Okay, so iron ore gets repriced instantly, especially in the future markets. And that's why the Australian dollar reacts faster and then the New Zealand dollar reacts smoother. But the New Zealand dollar, I always say this in a lot of my webinars, the New Zealand dollars will eventually always follow the Australian dollar. It might react slower, but eventually it will follow the direction of the Australian dollar. So I guess you can say the Australian dollar is the first tell sign of where the New Zealand dollars will move. Hey, Cass, do you think China's targeted stimulus is just delaying pain or actually solving the problem? Okay, very good question. Okay, let me think about how I can structure this answer. Okay, so first and foremost, I do think that is a very good question. Do you think China's targeted stimulus is just delaying pain or actually solving the problem? Is it solving the problem? Okay, I would say it's stabilizing the pain, okay, it's not so much solving the problem, okay? I think it's just giving relief. Is it solving the problem? No, it's definitely not solving the problem. It prevents disorderly collapse, okay, but it doesn't recreate the explosive growth we see like before, like especially in the 2000s. Okay, so think of it as managing the transition that they are doing right now rather than fixing everything. So it's more like when you take paracetamol when you have pain, but it's really, really not solving the problem. Thank you for asking that question. It actually got me to think. Yeah, it's definitely not solving the problem. So if China sentiment turns positive, which forex pair would you pick first? Would it always be the Australian dollars and the New Zealand dollars? Okay, very good question. Okay, to answer this, I think the Australian dollars, I definitely would pick the Australian dollars first. Okay, because it reacts first. Like we said, the New Zealand dollars is going to be slow, and it will definitely give you more momentum, definitely give you more um volume. Okay. New Zealand dollar is cleaner for swing positions, but Australian dollar gives you the first bounce when sentiment flips. So it depends on your volatility tolerance. I definitely would go for New Zealand Australian dollars first. Okay, I've got a very good question here. Thank you for asking this, Joash. Does stimulus in China still impact gold like it used to or not? Okay, this is a very good question. This is something I actually want to talk about. Okay, so the stimulus in China definitely still impacts gold, but less directly than before. So gold reacts more to yields. The US dollar direction and risk sentiment. Okay, so China's stimulus can support the risk appetite, which indirectly helps gold, but it's no longer, definitely no longer a one-to-one driver like it used to be, like back in the days. Okay, so thank you for asking that question. I know every week I come on here, there's always a question about gold. If the Fed cuts and China stabilizes at the same time, is that a bullish for Asia? Um, sorry, let me digest your question. If the Fed cuts and China stabilizes at the same time, if the Fed cuts and China stabilizes at the same time, is that bullish for Asia? Yes. Okay. That is a classic risk on setup. USD weakens, okay, and we're talking about stabilization in China, usually supports the Australian dollars and the New Zealand dollars. Not just that, we also have the Asian equities and the emerging markets forex. It doesn't mean everything will skyrocket for sure, but it definitely will shift sentiments positively. Okay. Okay, I got one more last question here I'm gonna answer and then I'm gonna call it a day because I don't see any more questions coming in. Okay, Cass, this is for the big picture. Do you still think China is still investable today? Or is it the end of that growth? Okay, very good question. This is a question I ponder on a lot because China is a market that I personally want to go and invest in. I don't speak Chinese, by the way. I'm Chinese, but I have very terrible Chinese. I came to Singapore 10 years ago. I'm Malaysian, by the way, and I came to Singapore about 10 years ago and I picked up Chinese, bits and pieces of Chinese here because although Singapore's national language, Singapore has four official languages and one of it is Chinese and one of it is English is the most used, but Chinese is the second. Okay, so this is a thank you for asking this. Do you think China is investable? I do think China is investable. China is still very investable, but the growth story is evolving. Okay, we're not talking about like property anymore. Okay, we're moving from the heavy construction, explosive growth phase and into tech. Okay, into tech consumption and high value add phase. Okay, it won't look like before the 2003 and 2000, like the early days, okay, the 2000s. It's not that, but it's a different sector. Okay, so if you plan to invest in China, it's not going to be construction materials, construction, whatever. Okay, it's going to be tech. It's going to be tech. Okay, so which is good for me because I so happen to have a business in tech, by the way. Okay, so that's all I have for you guys today. Thank you for joining my webinar. Thank you for those who stayed on, especially those who are Vantage website. Uh, Cass, when the RBNZ cut by 25 VPS, I wonder why the New Zealand USD got stronger. Why do you think? Since November 2016. Okay, 2026. Okay, so again, context matters. Okay, context matters. I'll be very honest, really I don't really pay so close attention to New Zealand because I don't really trade the New Zealand dollar that much. I trade a lot of the euro. Okay, so I don't know what happened, but it's definitely gone context really matters. There's definitely some other economic macro or micro data that was happening in New Zealand that helped the New Zealand dollars go stronger. But yeah, China will always just be one factor. Okay. It will always just be one factor to New Zealand and Australian dollars. They contribute a lot to the economy, but not enough. They're not Australia, they're not New Zealand. Whatever happens to China will definitely affect New Zealand and Australia, but whatever is happening locally in their own economy is also matters. So not sure what's happening internally in New Zealand, but it's definitely helping their own economy. Okay, so that's all I have for you guys today. Thanks for joining. I will see you guys next week. I will be tuning elsewhere next week. I'll be tuning in next week in a different country because I'll start my traveling next week. So I'll see you guys. Bye, guys. Thanks for joining. See you in a week. Take care.